Over the last 30 days, gold dropped nearly 9%, silver crashed more than 26%, and one of the largest private credit vehicles in the world, run by a giant household name asset manager, reported a drawdown of roughly 19% in a single quarter. These are not random events, they're connected. And today I'm breaking down 3 things you need to understand right now, not in a fear-based way, but in a clear, practical way that helps you protect your wealth and spot opportunity when most people are panicking. The real confiscation risk to your gold and silver. Is it real? Yes, but not in the way most people think. I'll explain a 3-tier playbook that modern governments use and what you can do to reduce your exposure. The private credit problem that major institutions are warning about. Why it matters, how banks are exposed in ways most people don't see, how derivatives can amplify stress, and what that can mean for gold, silver, and liquidity across markets. A mining stock framework and a short watch list approach. I'm not here to tell you to buy anything blindly. I'm giving you the criteria to evaluate miners properly, so you can remove FOMO and make decisions with structure. Let's start with the most misunderstood topic of all, confiscation. Part 1. The real confiscation risk. It's not what you think. The wrong question everyone asks. Every cycle the same question comes back. Will the government confiscate my gold like 1933? That's the wrong question, because modern systems don't need to repeat 1933 to achieve the same outcome. In 1933, the mechanism was blunt. Centralize gold, reset the price, and control the monetary base. Today, the monetary system is different, the legal environment is different, and the logistics are wildly different. So instead of asking, will they do 1933 again, the better question is, how do modern governments reduce the real-world usefulness of my wealth without looking like they seized it? That's where the 3-tier playbook comes in. Tier 1. Direct seizure. The headline everyone clicks, least likely. Let's acknowledge the fear. A dramatic executive order that demands citizens hand over gold. That story is emotionally powerful, and that's why it performs well online. But the conditions that made 1933 feasible are largely absent today. 3 reasons. 1. Monetary motivation is weaker. Back then, the currency system was explicitly tied to gold reserves. Centralizing gold helped expand the monetary base. Today, most major currencies are fiat. Central banks can expand balance sheets without needing private gold. 2. Logistics are a nightmare. In the early 1930s, much of the gold was centralized in banks. Today, ownership is widely distributed. Home safes, private vaults, different states, different countries, even family holdings with no formal registry. Door-to-door enforcement on a mass scale is politically explosive and operationally unrealistic. 3. Political cost to benefit is ugly. Even if a government could seize a portion of private gold, it's small relative to modern sovereign debt loads. The backlash risk is high, the fiscal payoff is limited. Does that mean direct seizure is impossible? No. Governments can always pass legislation in extreme scenarios, but if you're building a realistic risk model, Tier 1 is not the primary threat to plan around. The real risk is Tier 2 and Tier 3, because those can be implemented quietly, gradually, and legally. Tier 2. Stealth confiscation, taxation and penalty by design. This is where modern confiscation lives. You keep the asset, but the system takes the upside. Imagine a scenario. Gold runs hard over years, silver squeezes violently, you're sitting on large gains. Then a new policy appears. Emergency windfall tax on speculative commodities. Higher collectibles tax rates. Mandatory reporting thresholds tightened. Extra levies on strategic materials sales. No one calls it confiscation. It's framed as fairness, stability, or protecting the public. And politically, it's easier to sell because most people don't own meaningful amounts of metals. Metals profits can be portrayed as unearned or lucky. Taxing a minority is always easier than cutting spending. This is the modern play, not taking the gold, taking the benefit of the gold. State-level risk. the quiet layer people miss. Everyone watches the federal headline, but many aggressive wealth policies emerge at the state level first. Wealth taxes proposed, exit taxes discussed, attempts to tax unrealized gains. Even when these policies don't pass, the direction matters. When budgets are tight and obligations are heavy, the incentive to search for new tax bases increases. And physical assets become an obvious target because they're harder to offshore with a click, unless you plan ahead. Key takeaway: Tier 2 risk is less cinematic, more likely, and more continuous. Tier 3, the end game, control of the payment rails. Now we get to the one that almost nobody models properly. You can own your gold and still lose real-world freedom with it if the payment system is controlled. This is why the payment rails matter more than the asset. A future where money is more digitally monitored or programmable doesn't require conspiracy theories to be relevant. You don't need a dystopia for this to create friction. You just need heavier compliance, tighter transaction monitoring, and centralized permissioning for what converts into what. Even today, look at the direction of travel. Expanding reporting, stricter KYC AML, more automated risk scoring, broader flagging of transactions. Now apply that to metals. How this can hit you in practice. You go to sell gold. The dealer can pay you, but the payment may go through systems that can delay, freeze, request additional documentation, apply withholding taxes automatically, or trigger reviews for suspicious activity. You still own the metal, but the conversion from metal, spendable money, becomes bureaucratic and conditional. Not seizure, friction. And friction is enough to reduce usefulness. How to protect yourself. Practical, non-hysterical. This is not about panic, it's about structure. Here are practical ways to reduce exposure across the tiers. 1. Think in jurisdictions. Don't keep all meaningful wealth under one set of rules if you can reasonably diversify. 2. Keep documentation clean. If you ever need to sell, transfer, or declare, messy records create vulnerability. Receipts, purchase history, storage documentation, boring but protective. 3. Plan liquidity. If your plan is, "I'll never sell," ask, what about emergencies, taxes, relocation, or medical events? Liquidity planning prevents forced decisions in bad moments. 4. Consider denomination and flexibility. If everything you own is in large bars, it's harder to transact discreetly or partially. A mix can improve optionality. 5. Don't confuse ownership with accessibility. If your metals are held through layered counterparties, your broker has a contract with a custodian who uses a sub-custodian, your ownership may be more theoretical under stress. The point isn't paranoia, the point is resilience. Now let's connect metals to the bigger financial storm, private credit. Part 2. The brewing private credit problem and why it can move metals. 830 to 1830. First, a quick reminder. Liquidity moves everything. In a true liquidity event, when leverage gets unwound, markets often do something that confuses people. Why is gold down if fear is up? Why did silver get hammered if the macro is getting worse? Because in the early phase of a credit shock, people sell what they can, not what they want. They sell liquid positions to meet margin calls, redemptions and collateral requirements. That's why you can see metals drop, miners drop harder, and even safe assets wobble temporarily. Then later, after policy response, bailouts, currency debasement fears, or real rate changes, metals can reassert. So the key is understanding the transmission mechanism. What is private credit? Private credit is lending done outside traditional public bank loan markets, often by private funds, credit vehicles, alternative asset managers, non-bank lenders. It grew massively over the last decade plus because banks faced tighter capital rules after 2008, demand for yield stayed high, and companies wanted financing with fewer public market constraints. The result? A market commonly estimated in the trillions globally, with large pockets of opacity. Opacity is not automatically bad, But opacity becomes dangerous when losses rise, refinancing becomes difficult, and no one knows who holds what risk. That's when confidence breaks. The hidden link: banks are still involved. Many people assume if it's non-bank lending, banks aren't exposed. That's often wrong. Even when banks aren't the direct lender to the end borrower, they can be exposed through credit lines to funds, warehousing arrangements, securitizations, total return swaps, derivatives and hedges, prime brokerage and collateral chains. So the system can look diversified on paper while still being connected underneath. And in credit events, what matters is not just losses, it's forced selling and margin mechanics. Why margin changes can smash silver and sometimes gold. Futures markets are leverage machines. If margin requirements rise, leverage traders must post more collateral. If they can't, they sell. And when a large cohort sells at once, price gaps lower, even if the long-term fundamentals haven't changed. Silver is especially vulnerable because it's smaller than gold, typically more volatile, more sensitive to positioning, and often used by traders seeking leverage. So, a margin-driven unwind can create a waterfall move. That doesn't prove manipulation, it proves structure. Leverage plus margin rules plus crowded positioning equals violent moves. Why warnings are increasing. Institutions have been flagging higher default risks in pockets of corporate debt, refinancing walls, large maturities coming due, weaker borrowers dependent on low rates, and valuation uncertainty in private assets. The issue isn't all private credit is bad. The issue is when downturns hit, transparency drops, pricing becomes delayed, and losses can show up all at once. That's how stable return products can suddenly gap down when assumptions break. The derivatives multiplier, the part that can turn stress into a domino effect. Derivatives themselves aren't evil. They can hedge risk, but they can also create hidden leverage, link institutions through collateral obligations, and amplify losses through forced rebalancing. In a credit event, a few things can happen quickly. Defaults rise, spreads widen, hedges demand more collateral, counterparties reduce exposure, credit tightens further, and the cycle accelerates. This is why credit crises often feel non-linear, slow, then sudden. Bail-in risk. What's realistic to worry about? Let's be precise, not sensational. In most developed systems, insured deposits, up to certain limits, are designed to be protected. But uninsured deposits, concentrated accounts, or funds held in certain structures can face risk in extreme resolutions. Also, even if deposits are technically protected, access can be delayed during crisis periods, and capital controls or withdrawal limits can appear in stressed jurisdictions. So the real point is, don't keep critical liquidity above insurance limits in one place without thought. Don't assume the plumbing will work perfectly in a shock, and avoid building a plan that fails if you can't access funds for weeks. This isn't about predicting collapse, it's about not being fragile. What this means for gold and silver, two-phase reality. Phase 1, deflationary liquidity shock, forced selling hits everything. Metals can drop temporarily, miners often drop more. Phase 2, policy response, currency credibility. Rate cuts, liquidity injections, bailouts, fiscal expansion, real yields can fall, currency debasement fears can rise, metals often regain strength. So if you only understand metals as crisis goes up, you'll get emotionally whipsawed. The better model is liquidity first, narrative later. Now, if that's the storm, where's the opportunity? Mining equities. Part 3. Mining stocks. A structured way to evaluate opportunity. Why mining stocks move so much more than metals. Mining stocks are not gold. They are businesses with costs, management, jurisdiction risk, financing risk, operational risk. But they also have operating leverage. If gold goes up while costs stay relatively stable, profit margins expand fast. A simple example: gold price, $2,000. Cost to produce, all in, $1,200. Profit per ounce, $800. Now gold rises to $2,500. Profit per ounce becomes $1,300. That's a 62.5% increase in profit from a 25% move in gold. That's why miners can outrun metals in bull moves. And that's also why they can collapse faster on the way down. So the game is not buy miners. The game is buy the right miners at the right time with the right risk control. The framework. How to evaluate a mining stock. Write this down. 1. All-in sustaining costs, AISC. This is the true keep the lights on cost per ounce. Lower AISC equals more resilient in downturns. Bigger margin to spot price equals more upside torque. Watch for rising AISC trends, energy sensitivity, labour inflation exposure. 2. Production profile and growth. Ask, are ounces growing or shrinking? Is the mine life stable? Do they have a pipeline? A miner with shrinking reserves is a melting ice cube unless it's replacing ounces through exploration or acquisition. 3. Jurisdiction risk. Permits, taxes, stability. A great deposit in a high-risk jurisdiction can still be a bad investment if permits are unreliable. Royalties can be changed overnight, community relations are unstable, nationalization risk is real. Jurisdiction can matter as much as geology. 4. Balance sheet strength. In mining, cash is oxygen. Look for low net debt, manageable maturities, enough cash to survive a down cycle, disciplined capital allocation. If the company needs to raise money at the bottom, you get dilution, often brutal dilution. 5. Producer versus developer versus explorer. Know what you're buying. Producers. Cash flowing, lower risk, still volatile. Developers. Pre-cash flow, need financing, higher upside, higher risk. Explorers. Optionality lottery tickets, can go to zero easily. Your position sizing should reflect that. A practical handful approach without blind buying. Instead of chasing whatever is trending, build a structured watch list across 3 buckets. Bucket A, quality producers, core exposure. Look for low AISC, multi-mine diversification, strong jurisdictions, consistent execution. These can act like equity gold without being pure speculation. Examples to research, not recommendations. Large to mid producers with multiple mines in stable regions. Royalty streaming companies, often lower operating risk than miners. Royalty streaming businesses deserve special attention because they have exposure to metal upside but less direct cost inflation risk and no day-to-day mine operations. Bucket B. Turnaround, re-rate candidates, medium risk. These are miners where the market is skeptical, but costs are improving, a new mine is ramping, debt is coming down, or a major catalyst is approaching. You're looking for before and after moments, before re-rating, before a new production phase, before a key permit or feasibility update. Bucket C. Developers with realistic paths, high risk, high potential. Here's what matters most for developers. Do they have a credible timeline? Are permits realistic? Is CapEx reasonable or fantasy? Do they have strategic investors? How much dilution is likely before first production? A developer can have a world-class deposit and still be a poor investment if financing is impossible. The checklist that saves you from FOMO. Before you touch any mining stock, answer these questions. What is the catalyst? Earnings re-rate, cost reduction, production ramp, permit, feasibility study, M&A potential. What breaks the story? Permit denial, cost blowout, community conflict, financing failure, dilution, technical risk. What's my time horizon? Producers can be traded. Developers may require years of patience. Where is my risk control? If you don't know where you're wrong, you don't have a plan. You have hope. Is the move already done? If you're buying after a vertical spike, you're likely late. Why opportunity often appears after ugly sell-offs. Mining stocks regularly overshoot to the downside because ETFs indiscriminately sell baskets, margins force liquidations, sentiment collapses. When that happens, some miners trade as if gold will collapse permanently, their assets are worth nothing, or they'll never refinance. That's rarely true for the best operators. So the best opportunities often come when the chart looks terrible, the news flow is negative, and most people have emotionally checked out. Your job is not to predict the bottom perfectly. Your job is to identify quality, wait for confirmation, size correctly, and avoid catastrophic drawdowns. Closing. What to do next? Let's tie this together. Gold down, silver crashing, private credit wobbling. These aren't isolated events. They're symptoms of a system where leverage, liquidity, and policy risk are colliding. Here are your 3 core takeaways. Confiscation risk today is less about raids and more about policy. Taxes, reporting, transaction friction, and payment rail control can reduce your real freedom without ever seizing the asset. Private credit matters because it's opaque and interconnected. When stress rises, derivatives and collateral mechanics can amplify shocks, often faster than people expect. Mining stocks can be incredible opportunities, but only with a framework. Focus on AISC, production growth, jurisdiction, balance sheet, and category, producer versus developer. And never confuse upside with certainty. If you want to protect wealth and still pursue opportunity, the goal isn't fear. The goal is to be hard to break, financially, psychologically, and structurally, when the system gets stressed. That's how you win the decade.